What else is there?
So yeah, I was like, yes, the whole time I was doing it, I was just thinking like about all of that. Yeah.
So I had their first range. Whatever. But I literally will find there. Yeah.
So it is the last week before the break, so I want to remind you, maybe this is a good week to at least get started on your DCF. If you haven't started, if you've already done so, great. If you've not picked a company, I don't even want to talk to you. How many times can I nag you about that? But the sooner you get started, the bigger that burden is of getting, that's I think the toughest part of this is stop reading about your company. Stop reading what other people think about your company. Sit down and give it a shot, right? Okay. So let's continue with our discussion of loose ends. So we're going to start with a series of tests. It's going to lay the foundations for what we're going to talk about today. Almost every company you look at has a cash balance. Depending on the company, it can be a small one and large one. If you're looking at Google, it's 110 billion. Apple is 160 billion. Used to be 250 billion. It's down from 250. And most companies have billions of dollars in cash. Not tens of thousands, but billions of dollars in cash. And for a business to show something as cash, at least based on GAAP or IFRS, to show it as cash and marketable securities, that money has to be invested where? What are the requirements for a company to be able to call something cash and marketable securities? Liquid and close to riskless. So right now, where is that money invested? T-bills and commercial paper issued by AAA companies. So let's play it out. Let's say you take a company with 50 billion in cash. It's invested in T-bills and commercial paper. What's the rate of return that that company is earning right now in the cash? About 5%. So I'll play out what I've heard, and I've seen people who should know better say about cash. This came from actually a well-known consulting firm that was advising companies, and it said, look, markets will punish you for having cash. Why? Because the cash earns only a 5% return. It used to be 2 or 3%, it used to be 0% for a while. Whereas you earn a return on capital of 12, 13, 14% on the rest of your investments. See the logic of it, right? Cash earns less than your regular investments. So markets going, what's wrong with that? Because that logic must be absolutely wrong, because if that's true, no company should ever hold a cash balance, should try to roll into. What's wrong with the logic of that statement? Yes, David.
An average performance, but you have periods where sort of you're expected.
What if I took the average return on cash over the last 50 years, the average return and everything else, I'll still wage, and the average return on cash is going to be lower, good times and bad times put together.
Doesn't the argument assume that there's always going
You don't make it a passive statement, make it an active statement. So what is your argument?
The argument assumes that there's always going to be opportunities for investment where we can earn that cost
So that's fair enough. You're saying, what, but then why don't they give the cash back?
because they're waiting on the opportunities to arise.
But still, while it's sitting there, then you're agreeing with them that it's wasting, right? So earning a lower rate of return. So did everybody get Gandharv's point, which is, hey, the cash earns a lower return, but maybe they're holding it but while you're holding it, then you're agreeing with the argument that it's a wasting asset, that it's a bad investment. Yeah, man? Okay, but what business, why should a company be doing that? Why take on something I should be doing as an investor? They're holding T-bills for me, right? Why would I want Google to do that for me? Yes, go ahead.
Lowers the beta.
Again, same argument. Why would I get no benefits from lowering that beta, right? Because with that lower beta comes a lower return. It's not like I get a. Just 2 days ago, I am my unofficial portfolio manager for my kids. I don't know how I got this job. I don't think I want to be fired, but they don't want to seem to fire me. So 2 days ago, I went in and swept all their cash into T-bills. I don't know whether you're aware of the fact that you can directly invest in T-bills. You go to the Treasury website, you can take part in an auction, and basically this bypasses, you're not doing it through a money market fund, basically buying T-bills directly. I swept all their money into 6-month T-bills. You know what annualized return they're going to be earning? About 5%. Here's the question to ask when you think about cash. Cash isn't something liquid and riskless. The question you should be asking is, what would I make if I invest in something liquid and riskless right now? And the answer is about 5%. Cash is not a wasting asset because it earns a fair rate of return given what's invested in. That's why you're okay with a company holding 100 billion in cash. We can argue about how it lowers beta, but that's in fact no value creation or value destruction. Cash invested in T-bills and commercial papers is zero net present value investment. But let me ask you a follow-up question. Google has $110 billion of your cash invested in T-bills. The good news is that as long as it stays invested in T-bills, you're going to be okay. But what worries you when you see a company with a big cash balance? You have a lot of cash, you're a manager. You're going to be looking for things to do, right? It's not the cash itself that worries you, whether you trust the managers not to do stupid things with the cash. Today, we're going to look at evidence of what markets do with large cash balances, and they differentiate across companies. In some companies, they're perfectly okay with 100 billion in cash. In other companies, 5 billion in cash, they start discounting the cash. But it's not because the cash earns a low rate of return, but because what managers can do with that cash. Call it a stupidity discount. Essentially, markets are saying these managers are so stupid based on their history, we're going to knock down the value of cash in their hands because they'll find a way to waste the cash. I'm going to talk about cross holdings, but before we talk about cross holdings, I want to get a sense of whether you get the accounting for cross holdings. Okay? So let's say you have a company, you're valuing a company, call it company A, and it owns 60% of another company. And you're looking at company A's financial statements. You're trying to value company A. How much of that subsidiary will you see? So as you look at the income statement, you have revenues, operating income, etc. How much of that subsidiary, if any, will you see?
100%.
100%. Why? Because both IFRS and GAAP require what's called consolidation. What does consolidation mean? When you own more than 50%, actually effective control, it doesn't have to be 50, it could even be 40. But if they view you as being an effective control, they require you to consolidate. What does that mean? You got to count 100% of the revenues of the subsidiary. So when you look at revenues or operating income for your company, you're counting 100% of the subsidiary. And how do we compute free cash flow to the firm? We start with the operating income and we multiply by 1 minus the tax rate. Do you see where this is going to lead you, right? You're going to value 100% of the subsidiary in your discounted cash flow valuation. How much do you own though? 60%. There's a cleaning up to do. What is that cleaning up required? That you subtract out the 40% that doesn't belong to you. We'll talk about how analysts do it. They cheat. They look at the balance sheet. There's an item on the balance sheet that they claim is the 40%. But we have to talk about cleaning up for that 40%. That's if you own a majority stake. Let's flip the problem a little bit. And let's suppose company A owns 10% of company B. Now work me through the same process. You're computing free cash flow of the firm from the income statement. How much of the subsidiary is in company A's numbers? You look at the revenues. How much of the subsidiary is there? 0. Operating income, 0. It's below the operating income line that you'll bring in the 10%. So to get to net income, you count the 10%. But if you're starting with operating income, guess what you've done? You haven't valued any of that subsidiary. So to clean up that, what do you need to do? You need to value the subsidiary and add the 10%. So in the first case, you have to subtract out the 40% because you overcounted. The second case, you have to add the 10% because you didn't count it at all. We're laying the foundations for all of that stuff you need to do below your valuation. What do you add on? What do you subtract off? And the question always is, have I already valued? The answer is no, you got to bring it in. But if you already valued it, then you got to say, did I value it correctly or do I have some cleaning up to do? So let's say you've done your discounted cash flow valuation. You've added the cash, you cleaned up for cross holdings, and then you decide to take a look at the balance sheet. Bad mistake, because now you're going to be tempted to start adding other stuff. So I'm going to list out some items on the balance sheet, and I want you to tell me if you valued a company, whether you'd be adding these items on. So you've done a discounted cash flow valuation, free cash flow of the firm, discounted back at the cost of capital. You come up with the value of $1 billion. The company, though, has a headquarters building right in the middle of New York City that's worth $200 million. Should I add the value of that building?
Yes.
You're very quick to say, who's in that building? Let's say JP Morgan, 277 Park. I don't even know that they own it. Let's say they own 277 Park. That building is worth $500 million. But who's in that building? Traders and bankers, right? What do? Presumably something that creates income and revenues, which is already in your cash flows. When you look at an asset which generates cash flows, you can't have your cake and eat it too. If you count the cash flows from the asset, you can't add the value of the asset as well. Now, of course, you can have a legitimate point of 277 Park is too expensive. What if I move to a cheaper building? And that's a different question. But you cannot count an asset and the cash flows from that asset in the same valuation. You value the Waldorf Astoria, right? The real estate alone is probably worth $1.5 billion. It's a huge property. But if I value it as a hotel, and I come up with the value of $1 billion, I can't add the $1.5 billion on top of the $1 billion. That will be double counting. So that's something we need to talk about today. What do we do about it? What if we have vacant land? Is there any vacant land left in New York? Let's say it's in the East Village, vacant land. It's filled with drug dealers right now, but it's an acre of vacant land. Should I add the value of that vacant land? Before you say yes, what's the question you need to ask me? When I did the cash flows. Sorry, Dor. Let's say you did the cash flows. So let's suppose you ask yourself, the question you're asking is, did I build in an expectation that I was going to use up the vacant land in my cash flows? The answer is no. Then you can add the vacant land. Remember, you are the one estimating the cash flows. You should know what you've built in. And if you haven't built it in, bring it in. But if you already built it in, do it. Which kind of answers the next question. What if you're valuing a pharmaceutical company that, let's say valuing Novo Nordisk. It has a patent to Wegovy and Ozempic for the next, let's say, 12 years. It's a valuable patent, right? If you value Novo Nordisk, should I add the value of the patents to my discounted cash flow valuation? What do you think, Herman? When you value Novo Nordisk, so let's say you did the Novo Nordisk value, your projected revenues, right? Your projected margins. When you made those projections, because when you did the projections, what do? You gave them high growth and high margins because you can't add the patents to the extent that you've already built them into cash flows. By now you see a pattern in how you answer the questions, right? Have I already counted it? The answer is yes, you cannot add it in. Brand name, you're valuing Coca-Cola. Right? Increasingly, IFRS allows you to bring brand name onto the balance sheet. Let's say you're valuing a European brand name company like Coca-Cola. You've done a discounted cash flow valuation. Should I add brand name to it? This is why I'm terrified of what accountants are doing with brand name, because you're going to see people tempted to add brand name value to DCF valuation. That's definitely double counting. What about goodwill? This should be an easy one. The answer for this is absolutely not. It's not even an asset. You just made it up. It's an X variable. What if your CEO has gone a little crazy and bought Picassos to hang all over the headquarters building using company money? You say no?
Yes.
Technically, it's yours, right? It is yours. Just don't do anything crazy and say, I'll take my share of a Picasso. I'm a shareholder. No.
I think it was once, I don't know, There was like something about the owner doing something like that and. he
You
was
know what,
saying
there are
that
old
trans
European
customers-
companies that are, you look at what they own. Remember, many old European companies come from these very rich families that have chalets and, fine paintings that they bought with corporate money. Baccarat. I'm sure there are assets there. You say, well, I mean, what about those, Fifth Avenue apartments that many companies own as a corporate penthouse? Technically, it belongs to you. So you should be adding it on, but these are exactly the kinds of things that companies are not going to reveal unless you did your own investigative work. Yes, Dave.
Wouldn't owning art be counted as influencing the cash flows because you can get tax deductions from them?
If you do, so as I said, you did the cash flows, if you brought in the tax reductions, it brings in part of the artwork, right? So you own a Picasso, you got it. Will it capture the entire value? I'm not sure. It depends on what you were able to amortize. I don't know what the laws are on fine art. But effectively, if you brought it in, then you don't want to double count it. So those are all issues. And you can see, this is what I mean by loose ends. These are the things you run into. I want to reshare because I think I shared the wrong screen. So let's go back to the cash question that we started. By itself, cash, as I said, is invested in something liquid and riskless. It's usually earning a low rate of return for a long period, almost a decade, and on no rates of return. But it is earning a fair rate of return. So the traditional way we've always dealt with cash is don't mess with it, right? You have $1 billion in cash, you do a discounted cash flow valuation, free cash flow of the firm at the cost of capital, you add the $1 billion. When you do an equity valuation, though, things get trickier because what's the earnings number you start with to do equity valuation? Net income. And net income, if you're not careful, already includes the interest income from cash. So if you're doing an equity valuation with net income as your starting point, you can't add the cash back because in effect, you valued cash, perhaps badly, but you valued it. That's why if you remember, I talked about non-cash net income to do free cash flow equity. The reason I did that is I want to keep cash separate from all of your other operating assets. So equity valuation is a bit of a mess, but to understand why you might attach different values to cash in different companies, I'm going to show you 3 companies. All 3 companies have the same enterprise value. What does that mean? Free cash for the firm, discounted cost of capital, $1 billion. All 3 companies have $100 million in cash. But here's where the 3 companies are different. Company A has historically earned a return on capital of 10%. That's all you have is history. They've historically earned a return on capital of 10%. Their cost of capital is 10%. Company B has historically earned a return on capital of 5%. Its cost of capital is 10%. And company C has historically earned a 22% return on capital. Its cost of capital is 12%. First 2 companies are US companies. The third company is an Argentine company. I'm going to argue that in one of these 3 companies, cash will be a neutral asset. You know what I mean by a neutral asset? 100 million is going to be valued at about 100 million. In one of these companies, I think you're going to discount the cash. And if you pick the company, I'd like you to tell me why you're discounting the cash. And in one of these 3 companies, you might actually attach a premium to the cash. Let's start with the easy one here. Which of these 3 companies is most likely to be the company where cash is a neutral asset? Go.
The one with return on invested capital.
And tell me why. What is that company doing?
Essentially, the cash, it would be, it's earning this, it would be earning the same return on its cash as if it was investing it in its own.
Now, so when you earn exactly your cost of capital, if you think in terms of capital budgeting, what type of projects are you taking? You're earning 0 net present value project. You're taking the whole. I call these block companies. Block companies, what do? They do no harm. They're like following the Hippocratic Oath. Basically, they're running in place. You think that's terrible. There are far worse fates than getting a block company. Block company at least earns its cost of capital. You're saying this company does no harm. It does no. So basically, even if they decide to invest the cash, they'll take another 0 net present value. No harm. So company A is going to be a neutral company. Which of the other 2 companies are going to attach a discount on? I6 company. Tell me, what about company C? Let's say how much your cultural biases are playing out here. What is it about company C that scares you?
So, basically, it's not in the US, it's in Argentina.
So, and in fact, I showed this for a Brazilian audience to a person. Every person in the audience said, company C. I said, why? You can't trust those Argentines. And, so some of this is an emerging market. You worry about, what will. So let's take that out of the picture. Let's assume that this company is not playing games. Let's assume that they're actually earning a 22% return on capital. So the history is, even though they're an Argentine company, is they've been run pretty well. They're a well-managed company.
Yeah.
So if I take that concern out, would you still say company C?
Yeah.
Why?
Because they having cash on the balance sheet, potentially those value structure instead of value creation.
Where's the value? I can see not having more value in addition. You're saying if I took the cash, invested in 22%, but where's the value destruction?
That their cost of capital is higher than the yield of.
Oh, no. Now you're falling into the trap of what this more in the start of the class, we said if you earn a 5% on cash, it's okay. So as long as they're earning 8%, and that's the riskless liquid rate of return, that's fine, even though it's lower than the cost of capital. The fact that cash earns less than the cost of capital is a very tight test. No company can pass that test.
I didn't understand the last part.
No, but no, so just because a cash almost always will earn less
Yeah,
than the cost of capital, right? That is okay, we said, because it's
No,
liquid and
I
riskless.
talk more about the opportunity cost of not earning.
But I'm saying that's not value destruction, because that's an argument for why don't you take more projects at 22% and create even more value for me? We can debate that. That's a good point, but that's not a point about discounting cash. You're saying it could be even more valuable invested in projects that make the 22%.
Yeah.
But right now, it's not, this cash itself is not ruining your value. It means you can be even more valuable if they invest the cash. But I'm looking for a company with discount the cash. Manish? Well, to the extent that your cost of capital already includes inflation and you're earning a riskless rate, that also includes inflation by itself, unless you're holding currency.
But you have cash in a high inflation.
Only if inflation is higher than expected. If expected inflation is high, cash is completely safe, right? You built it in, the interest rates will reflect that. Justin?
Isn't it B?
Tell me, what is it about B that worries you?
Invested capital is then operating.
No, give me in business terms, what is
earning less on its
it's
investments?
a bad company, right?
Way
Badly
better.
managed, investing low rates of return, and they have your cash. That's why-
Lower.
You're worried. The cash itself is not worries you what they can do with the cash. And their history suggests that they can find bad uses for your cash. Another big acquisition. And you're attaching a discount ahead of the time because you're worried about what they will do with your cash. Sounds outlandish. Do markets actually do this? I'm going to show you the result of a study, which I think is one of the most fascinating studies I've seen in academia, where when you look at the cash, the question you're asking is, what will the cash be invested in? And companies where you don't trust the management, you start to attach a discount to the cash. So let's look at the study. Basically, what it did was it looked at all US companies. This was about 20, 25 years ago. I haven't seen an update of the study. And it asked a question of how much is the market valuing $1 in cash in the hands of a company? Across the entire sample, they came back with a conclusion that $1 in cash is worth $1. You're saying they did a study to find this out? This is good news for us, though, because this is what we do typically in valuation. We value cash at its face value. But then when they looked at mature firms, these are low growth firms with negative excess returns, that's like company B, they're earning less than the cost of capital. $1 in cash is valued at 69 cents. That's an astonishing discount. I mean, think of what I've just said. You got a company with a bad history with $10 billion of cash. What's the market valuing it at? 6.9 billion. If you were the consultant to this company and they asked you for advice on how to increase their value to shareholders, what's your advice going to be? Give the cash back. They'll fight it tooth and nail. We've changed, we're a different company, but the market is discounting cash in the hands of the company. And these are the companies that activist investors love to target. You see why? You're a Carl Icahn. You're not the deepest thinker on the face of the earth. Every Carl Icahn sales pitch is, you have too much cash, give me the cash. You see why with these mature, Because the minute that cash gets returned, the discount disappears. You don't have to do any operating restructuring. There's no financial restructuring. Just take the cash off the balance sheet. The discount disappears because you no longer control the cash. And if you look at companies which are high growth companies that earn more than their cost of capital, there's actually a premium attached to the cash. And here I'm going to go back to the Argentine example. You open up any corporate finance textbook and you look to see what should the optimal cash balance for a company be? In traditional corporate finance, you know what the answer is? Zero. Because here's what we assume. You have a great project. You can go out and raise capital. Capital markets always open and accessible. They give you capital at a fair price. And you can take every project you want. Completely unrealistic, right? But if you're an Apple or you're Microsoft, raising capital is like easy to do. Do you see why I put the third company in Argentina? Just in this century, Argentina has had at least 5 episodes where the entire capital markets have shut down. Equity markets have shut down. Lenders will not lend money. Do you see the advantage of having cash in a market where capital markets can shut down? And it's advantage of having cash is not only does it allow you to survive the next crisis, it actually becomes a strategic weapon. In what sense? You can use it to buy assets from other companies that are desperate for cash. In markets of companies which have capital rationing, limited capital, you can see the advantage of holding cash, especially if they're in a good business. It allows them to survive and make it through. Many of you are valuing young companies with lots of potential. Do you want your young company with lots of potential? Say it's a tech company. Do you have a large cash balance or a very small cash balance? You want it to have a large cash balance because here's how young tech companies go out of business. They run out of cash. And if the venture capitalists are no longer supplying capital, they're dead in the water. So if you have lots of potential, you will need to survive. So one of the things that you can use to think about that failure risk in your company, in fact, analysts used to measure how many months of cash companies had on the balance sheet as a measure of risk. The more months of cash you have, the less risky you are. You effectively give them a premium. So in the real world, companies differentiate. Don't do anything crazy in your intrinsic valuation. Take $1 in cash, value to the dollar. But if you find a company to be undervalued, and it's a company where 30% of the value comes from cash, the question you might be asking is, have investors stopped trusting my company? In which case, for you to make money on the stock, what has to happen? You're going to buy the stock, and every day you're going to get down and you say, please God, let Carl Icahn target my company, right? You need somebody to unlock that, because left in the hands of management, that discount might continue for a long time. So that's cash, easy to value, right? Let's move one step up the ladder to companies that actually, their entire asset base should be easy to value. You know how mutual funds, most mutual funds are set up? They're set up as open-end funds, which means if you take $1 million of your money and you send it to Fidelity, all that, and let's say it's the Fidelity Magellan Fund, they increase the size of the fund, the shares in the fund, and your net asset value, what your money buys, is exactly equal to what was brought in. That's a traditional mutual fund. But there's a subset of funds called closed-end mutual funds. Closed-end mutual funds are actually publicly traded companies. You don't send your money to the fund, you buy shares in the fund. So you take your $1 million, you buy shares. The company takes $1 million and buys publicly traded companies' shares with it, Coca-Cola, Washington Post, Apple, NVIDIA, etc. So all of its assets are shares in publicly traded companies. So if I gave you a closed-end fund to value, I give you the 8 companies they hold, I give you the market values of those holdings, you should just add them up, and this should be the easiest of all companies. That's the value of the company, right? And you'd expect the stock price to be roughly equal to the value because this is the easiest of all companies to value. But in a finding that has had enduring power in finance, in the last 40 years, people have looked at closed-end funds. They've all come back with the conclusion that the typical closed-end fund trades at a discount of about 15% on the value of the stocks that are in that fund. There are 2 puzzles here. The first is, if you can value the stocks and they're at $1 billion, why would you ever value the fund in the market at $800 million? What's the explanation for that discount? Justin? One is illiquid, but they're all publicly traded stocks, right? Coca-Cola, how illiquid can it get?
Is the fund holding cash?
No, that could be an easy explanation. Is they're holding cash. So let's say the fund is fully invested. Many of these funds are fully invested. I said.
That even the performance.
Yeah.
versus market.
The fund is run by a fund manager, right? So when you invest in the fund, your money goes in the fund manager now controls the money. He or she invests the money. Let's play a game. Let's suppose the typical fund manager makes 11% return. I'm sorry, makes 11.5% return on average. But given their risk and what the market does, they should be making a 12% return. I'm actually being kind to this typical money manager because remember, the typical mutual fund manager actually underperforms by a lot more. This guy underperforms only 0.5%. So let's assume you invest $1 million in the fund. The money is being invested to earn 11.5% a year. Let's do the cash flows. It'll be, it'll be 115,000 next year, 115,000 the year after. If I take the present value of what you make and discount it back at the 12% you should be making, I'm going to end up with $969,000 is the value of my fund. Where did the $31,000 disappear? Because I'm underperforming the market by 0.5%, I'm going to discount the fund because I expect you to keep underperforming. If you underperform by 1%, that discount will drop to 8%. If I underperform by 1.5%, the discount will be greater. If I'm a growing mutual fund, the discount will get even larger. Growing, badly run mutual funds will have larger discounts. The answer to the question of why is there a closed-end fund discount is closed-end funds are run by active money managers. In the history of active money managers, it's like Company B. They earn less than the required return because they underperform the market. What happens if you outperform? You should trade at a premium. About 25% of closed-end funds actually trade at a premium on the net asset value. So let's take the most famous closed-end fund in history. It's Berkshire Hathaway. You see, Berkshire Hathaway is not a closed-end fund. Berkshire Hathaway is an insurance company, Geico, whose money has been invested by the most famous active money manager of all time, Warren Buffett, for much of the last 60, 70 years. So you have every insurance company has a closed-end fund because insurance premiums get collected, they get invested in stocks. But most insurance companies are very average managers. Their closed-end fund trades either at par or slightly below par. But Berkshire Hathaway was different. And the way this showed up, you looked at the market value of Berkshire Hathaway, and remember, everything is marked to market on their balance sheet. So Berkshire Hathaway's biggest holding for a long time was Coca-Cola. Now it's Apple. Every time Apple's stock price moves, the book value gets adjusted up. So when you see Berkshire Hathaway trading at a premium, it's trading at a premium on the market value of the stocks in the fund. And for much of Berkshire Hathaway's history, it's traded at a premium, well above book value and well above the price to book ratios of typical insurance companies. So in other words, people are valuing the fact that Geico is a very good insurance company, but they're attaching a premium because the closed-end fund was viewed as beating the market. That closed-end fund, though, if you look at the premium, it's basically disappeared over much of the last 20 years. It's, today, if you look at the price to book ratio for Berkshire Hathaway and you compare to the typical insurance company, Berkshire Hathaway actually trades at a slightly lower price to book ratio than the typical insurance company. Something seems to have happened over the last 20 years that's made the Buffett premium go away. What do you think explains that Buffett? One is age catching up, right? In fact, Buffett 10 years ago publicly turned over the picking of stocks in the Berkshire Hathaway portfolio to Todd Combs and Ted Wexler, two well-regarded value investors, but they're traditional portfolio managers. There isn't going to be another Warren Buffett, and the market has been pricing in, and he's getting older. That's a benign reason. But there's another reason which I think cuts deeper. Warren Buffett is, of course, the best-known practitioner.
The other reason, size.
That could be playing a role as well. Now finding the next, when you're 600, $800 billion company, that's playing a role as well. There's a third reason. What's the philosophy that's animated Warren Buffett's view to investing? What kinds of companies? You think in terms of the life cycle. What does a typical target company for Warren Buffett look like? Mature companies. Most of your assets are in place, and preferably in businesses that Warren understands. And one thing that I've learned as I get older is there are fewer and fewer things in the world that I understand. I don't understand TikTok, right? Why would you want to watch a 2-minute video? But my daughter probably has the exact opposite reactions of why would you want to watch a 30-minute video, right? Or an 80-minute lecture. So Buffett's area of expertise has basically been mature companies. And if you look at what's happened to that segment of the market, it's become smaller and smaller and smaller. So for multiple reasons, I think these things are playing out in Berkshire Hathaway, and the premium has disappeared. Be interesting to be at the next Berkshire Hathaway meeting, because for the first time in 60 years, you're going to have Buffett alone on stage. You're not going to see Charlie. It'll be another reminder that mortality catches up with all of us. So morbid thought, hold on to that and watch Berkshire Hathaway as you go through, because it happens to any company that is linked to a person. What should terrify you about a Tesla? And now that Jensen Huang's being raised to the level of, minor level God, major level God in the eyes of people, you wonder how much NVIDIA will suffer if, in fact, he's no longer the CEO. The essence of great CEOs, you have to make yourself dispensable. I mean, you might like or dislike Jeff Bezos, but when I see him in a Speedo on a yacht, I think, good for you. You left a $2 trillion company. The company's been okay. Right? So it's essentially an extension of the cash out. Let's move on to cross holdings. Now, first step in understanding cross holdings is understanding the accounting for cross holdings. And broadly speaking, in IFRS and GAAP, there are 3 ways in which you can account for cross holdings. The first is if you own 3, 4, 5% of a company and you take no role in how that company is run. It's called a minority passive investment. And if you have a minority passive investment, here's what you're required to show in your financial statements. In your income statement, below the operating income line, I'm going to emphasize that, you have to show the dividends you receive on this cross-holding, dividends. And in the balance sheet, you have to show what you originally invested to get this cross-holding. To show you how disconnected these numbers can get from reality. The period in 1997, when SoftBank, then a young Japanese venture capital company, still run by Masayoshi Son, a younger Masayoshi Son, 70% of SoftBank's value came from one investment it had made in a company called Yahoo as a venture capitalist in the early 90s. That $50 million investment had become $7 billion, accounted for 70% of SoftBank. Let's say you opened up SoftBank's financials in 97. You looked at the income statement. What would you see there? Minority passive investment. You'd have seen the dividends they received from the Yahoo investment, which would have been in 97, it was 0. So you'd have seen nothing. Say, that's okay, I'll find it in the balance sheet. Go to the balance sheet, you'll see SoftBank's investment in Yahoo, and you'd see 50 million, reflecting the original investment. So this is the worst case scenario. Minority passive investments, what you see in the income statement, the balance sheet bears no resemblance. Let's move one step up the ladder, and thank God, this is the more common way to deal with minority investments, called the equity approach, minority active investments. Here's what you're required to do. In your income statement, again, below the operating income line, you have to show the percentage of the net income or the net loss. So if you own 10% of a company, you have to show that 10% as your share of the net income or net loss. Better than dividends, right? Because at least you're getting the earnings part. And in the balance sheet, you have to show the updated book value, because you now take your original investment, you add or subtract retained earnings in, so it's like an updated book value. Better than minority passive, but still very much stuck in the past. And then, of course, you get to 60%, and accountants flip out. They say you have to add 100. So when you're doing the revenues, they act like you own 100%. I say, no, I own only 60%. Don't worry about it. Operating income, act like you own 100%, but I own only 60%. Don't worry about it. You get to the balance sheet, act like you have 100% of the fixed assets. I own only 60%. Don't worry about it. And after about 15, don't worry about it. It's the last moment the accountant wakes up and says, but you own only 60%. Saying, that's what I've been trying to tell you all this time. You don't own 40% of this company. Absolutely. And the accountant says, we have to show the 40% that doesn't belong to you to make this right. So what shows up on a accounting balance sheet reflect the 40% that doesn't belong to you? Every company that consolidates, you'll see this item. It's got two names that will go under. The first is minority interest. The other is non-controlling interest. It'll always show up on the liability side of the balance sheet. Why? Because it's capturing the 40% that doesn't belong to you. So first step in accounting for cross holdings is understanding how your company is accounting for those cross holdings. In fact, now with joint ventures, take a look at Microsoft's financials, the joint venture with OpenAI. How is that shown? Or Disney. You know, Disney, when on both the Hong Kong and the Shanghai theme park, owned 49% of the theme park, not 51%, because the Chinese government, that was one of their requirements, is that Disney owned less. Now, the question is Disney showing it as a consolidated, which it might, because effective control, or is it showing up as a minority holding? So we have very different accounting. So that's the first step, understanding whether your company has cross holdings and what. So let's talk about assuming you have cross holdings, what you would do in a perfect world, where you had access to all the information you asked for. In a perfect world, to value a company with cross holdings, here's what I would do. I would value the parent company first, the parent company without any cross holdings. Then I would value each cross holding, whether it's minority or majority, doesn't matter. So I have 7 cross holdings, I'd value each of the companies. And then I take the percentage of each one that belongs to me, 10% of company A, 60% of company B, bring. See the advantage of valuing the cross holding separately? Each one can have its own growth and risk and cash flows, very different characteristics. They can be in different countries, you can bring them all in. In a perfect world, you would do an intrinsic valuation of every one of your cross holdings. But to do this, what would you need? First, at the company level, you need parent and consolidated statements separately. Most companies will report this, but there are some companies that report only consolidated numbers. Second, you need full financial statements for every one of the subsidiaries, which will be easy if they're publicly traded, but not if they're private businesses. Let's think of a case where I got pretty close to these requirements and was able to do an intrinsic valuation of the subsidiaries. The valuation I did of Yahoo in 2013 or 14 was 2 years into Marissa Meyer's stint as CEO of the company, and she was given this task of turning the company around. Impossible task, if you ask me. I decided to value Yahoo as a company. First, I valued Yahoo's operating business, its search engine, its mail program, and I came up with a value, and even with generous assumptions, about $7.6 billion. An intrinsic valuation of their operating business. Free cash flow of the firm discounted back at the cost of capital. But there were 2 big holdings that Yahoo had, which are both minority holdings that I did not count in my valuation. One was 35% of a company called Yahoo Japan. It's a publicly traded company that stands alone. They own 35%. They were treating it as a minority active investment, so it's not part of my free cash flow of the firm. And I valued Yahoo Japan because it's publicly traded at the financials. I valued them as a company, and the value of equity that I came up with, the 35%, for some reason, the Japanese still seem to be using Yahoo as a search engine. Don't ask me why, but 35% of that value is about. So basically, I've got 7.4 billion from the parent, 35% of Yahoo Japan. And then came the third component. And you're going to see why I had to wait till 2014 to be able to do it. Yahoo's best decision in the last 20 years was actually an investment they made in a very young Alibaba, where they acquired 21% of Alibaba. So it was a small business. Jack Ma needed the capital. They provided the capital, got 21%. Until 2013, the Alibaba piece was this blank slate because it was not publicly traded. 2014, of course, Alibaba decided to go public. They filed a prospectus. I did this valuation right after they filed the prospectus because it now had full financials. And the value that I got for Alibaba with very conservative assumption was about 146 billion for the equity. And 21% of that is 32.1 billion. I add the three numbers up and I come up with the total value. The value that I got was 4119, but much of that value comes from the cross holdings. Like the way to think about this is if you liked Alibaba as a company, you could have got it at a discount by buying Yahoo. There's one catch though. For that discount to unfold, Yahoo has to sell its Alibaba holdings, and if it's sold, then there'd be capital gains tax, so you'd have to take that into account. But this is a case where you could do a full-fledged valuation of the cross holdings on an intrinsic value basis. Most of the time, you will not have that luxury. I'll tell you a story to illustrate how difficult cross holdings can be to deal with. Late 90s, I was doing the second edition of my investment valuation. In fact, I'm doing the fourth edition right now. So if you bought the third edition last week and you can return the book, you should probably return it, but take a year for the fourth edition to come out. But second edition, I was valuing a Japanese company as part of the examples in the book. So I valued the Japanese company. In the late 90s, when valuing a Japanese company, you're always teetering on the edge of disaster because Japanese risk-free rates was so much lower than the rest of the world that if you're not careful, the thing would blow up. So I was very careful. I finished the intrinsic valuation. I'm patting myself vigorously on the back. And then I take a look at the company's financial statements. The company says it has 227 cross holdings. My task is laid out for me, right? Because to value this company right, what do I have to do? Value 227 other companies. I'm an incredibly lazy person. My reaction is, I don't even want to mess with this company. You have it. I'll move on. But in this case, I decided I was going to try, but I very quickly realized I couldn't do it. And here's why. 60 of the companies were publicly traded, but 167 of them were privately owned businesses. And I had zero information, nothing on the companies. So I called the investment relations officer for this company and said, look, I'm valuing a company. It's not for an expose, but I just need some information in your companies on revenues and operating income so I can value these cross holdings. She said, I cannot give you that information. Very polite Japanese lady. And she said, no. And I said, why not? She said, it's proprietary. The way she said proprietary was kind of scary. So I said, what if I bought 1,000 shares of your company and then called you? She said, no, still be proprietary. And I said, that makes no sense. I'd be part owner of the company, refusing to tell me what I own. He said, you have a point, but it's still proprietary. I get ready to hang up the phone. What's the point of banging your head against the wall? She said, wait, I do have something I can tell you about these cross holdings. I said, maybe she's going to tell me some revenue numbers or operating income numbers. I said, what? She said, I cannot give you the specifics, but they're worth a lot. I said, I'm sitting here with my Excel spreadsheet with a cell for cross holdings. I've tried entering LOT, and I seem to be getting error messages right below. I guess the computer doesn't know how many zeros there are in a lot, but it cuts to the heart of the cross-holding culture. Because what do managers do? They hold up a brown paper bag to you and say, trust me, it's full of cash. I'll tell you how much cash there is in the bag. And you say, can I look in the bag? No. And as long as we let them get away with it, why would they ever let you look in the bag? We get the companies we deserve. And when you look at markets, we have companies with lots of cross holdings. How do they get away with it? The answer is very simple. It's because we let them get away with it. Yeah. In those companies, you have to accept approximations. Here are a couple you can use. Let's say you have a cross holding in a chemical company, and you tell me your holdings, whether it's minority interest or a minority holding, is worth 100 million. That's a book value, right? Minority interests are book values. If I ask you, can you give me an estimated market value without any revenues or earnings? I can't value them. Can I reprice that holding? What do I need to do to get a repricing? What if I told you the average price to book ratio for chemical companies is 1.7? You have $100 million in a minority holding you think that is so unsophisticated. Guilty as charged, given the information you do. It's better than just using book value. So when you have minority investments or minority interests or minority holdings, if you can price them, go ahead. In fact, with Yahoo, even though I did an intrinsic valuation, some of the parts, I also did an intrinsic, I did a pricing some of the parts. Yes, go ahead, Dave.
Doesn't it reach the point where the valuation is so approximative, we might as well not do it?
It comes down to the question of these are the only, in many Asian markets, every company has cross holdings. So, if you're in a market where there are 3 companies with cross holdings, the rest are standalone companies, you're right. Just avoid the cross holding companies that are too messy. But if every company has cross holdings, many family group companies, this is a feature, not a bug. Then the question you got to ask is, I can't avoid all these companies. I have to invest in this market. Then the question is, how much, so you're right, it is estimates, you're building an estimates, but those estimates are going to be built on, do you trust this family group? Because they wanted to, they could really rip you off. But I agree with you. I don't like investing in cross-holding companies, but if they're priced at a low enough price where the cross-holding seem like icing on the cake, you might still go for the investment. So in the case of Yahoo, I priced all 3 parts. I priced Yahoo by applying, so I used EV to sales for all 3. Why? Because, it gave me maximum pricing flexibility. So you apply the EV to sales for Yahoo, for Yahoo's core business, for Yahoo Japan and Alibaba, you come up with a value pretty close to my intrinsic valuation in this case of about 39. Now, pricing of each part requires a lot less information. And this I could have done even before Alibaba went public, because you could get a sense of what the revenues were, even as a private business. So if you can, try to value cross holdings, especially if they're big parts of your company. Naspers, which is a South African company, gets 70% of its value from Tencent. Why? Because at some point in time, way back in history, when Tencent was a small private business, Naspers invested as a venture capitalist in that business. And Tencent, of course, has soared as a company, and Naspers is a pretty boring South African company. So to value Naspers, you got to value Tencent. There is no way around it. It's an indirect investment in Tencent. So you'd have to do what I did with Yahoo. So any questions about cross holdings? So what I'd like you to do is open up the balance sheet for your company. Check down the liability side. If you see a minority interest or a non-controlling interest, you already know you got the job ahead of you, because when you value this company, you're going to be valuing 100% the subsidiary, and you'll have to subtract that out. If you don't see anything on the liability side, go to the asset side. If under investments, you see investments in other companies. And usually you have to go to the footnotes to find these. And you got to say, this morning I was reading a news story that terrified me, that NVIDIA is investing in a bunch of companies across the board, which presumably will be AI users. It's creating a joint venture fund, right? And many big tech companies have a joint venture fund of other companies. And when you value these companies, you almost have to value the joint venture fund and add it on. Hopefully it's 2 or 3% of value, not 30% of value. And that becomes the challenge. Which brings me to what else should I be adding on? Remember the rule, you cannot double count an asset. You can't count an asset in the cash flows and the asset in the same valuation. So what are examples of assets you'd be valuing? One very simplistic asset that analysts, at least in the 1990s, added was if you had an overfunded pension plan. Let's step back. There are 2 ways you can create a pension plan as a company. Fewer and fewer US companies have pension plans to begin with, but those US companies that have pension plans have 2. One is called a defined contribution plan. The other is a defined benefit plan. Anybody want to explain to me the difference between the two pension plans? Go ahead.
Defined benefit is you pay in a certain amount and you get back. Your benefit is defined by mathematical formula, whereas with combined defined contribution, your benefit is what you put in.
You're just a conduit, right? So basically you let employees invest in you, you put the money in funds, the funds do well, you get a high pension. If they do badly. So with a defined contribution plan, you can never have an overfunded or an underfunded plan because there's no liability on your side. So as long as you put the conduit and you put it through, NYU as a defined contribution plan. But if you have a defined benefit plan, you promise your employees $800 a month for as long as they live. You collect money from them, you might make the investments, and if your assets do well, you can end up with the value of the assets exceeding what you owe these people on a present value basis. That's an overfunded pension plan. Could you have an underfunded pension plan? In fact, many legacy companies have a problem. The GMs, the Fords used to have very, very, very generous pension plans, and they have millions of, tens of thousands, maybe even millions of employees that they owe. You can have an underfunded plan. If you have an overfunded plan, technically that money belongs to equity investors. The reason I said technically is as a company, it'd be foolhardy of you to go tap that money and say, I'm going to take it out for two reasons. One is, you know how most pension plans get overfunded? It's not because you're putting aside too much money, it's because the market does really well. That's why in the late 90s, you had a lot of overfunded plans. The market went up more than expected. The second is, if you extract that money from that fund, you can kiss labor relations goodbye for the rest of eternity, right? Your union's not going to like it, your employees are not going to like it. So most companies don't tap in that. So, no. So I've seen people add that overfunding. Technically, you're on the right side, but it's probably not prudent. The other, of course, is if you have assets that you haven't counted yet. Yeah, we talked about some examples, vacant land that you haven't built into your cash flows. But I'll give you my favorite example of an asset that hadn't been counted yet. Anybody here part of the Michael Price? Nobody's on? You're on the Michael Price fund? Yeah. Actually, this is one of the only times I've ever had to ask money is the origins of this fund was Michael Price sold his mutual fund to a Japanese group for like a couple of $1 billion. He became a billionaire. And at NYU, the minute you become a billionaire, some of you might become billionaires. Trust me, you will get a lot of interest from NYU. They'll come to you and all of a sudden they'll discover that you're an old student and how much they enjoyed having you at the university. Remember all the bad moments here when they come back to you. Keep a chronicle of the difficulty you had in dropping a course, record that. So when they come and ask you for 100 million, you remember that. So when Michael Price sold his fund, they asked me, will you go ask Michael Price for money? And I said, not in this lifetime. I'm not going asking anybody for any money. You go ask for that yourself. But this is for a very special reason. We want to raise money to create this fund that MBAs can use to be active money managers. That's the Michael Price Fund. And for the last 20 plus years, the fund has been run by MBAs who basically pick stocks or hold on to stocks or sell stocks and pass it on to the next MBA class. You can look at the alpha of the fund if you want. It's actually not relative to the typical active money manager. It's done about as well as you can expect. I have zero official connections with the Michael Price Fund, but a lot of people who go through the fund have taken this class. So the way the fund works is if you want to get the fund to buy a stock, let's say it's NVIDIA, you create a pitch to the rest of the people in the fund. And if they like your pitch, they buy the stock. If they don't, so guess who they try their pitches out on first before they go out? So I become the receptacle for all these pitches on. What do you think about this? So about 15 years ago, I'm sitting in my office. This MBA barges in who's on the Michael Price Fund. And he says, I'm facing a conundrum. I very quickly swiveled to my computer, type in the word conundrum. I said, what the heck is he talking about? Turns out he was confused, but I liked the word. I said, what's your conundrum? He said, I'm valuing Playboy. And I said, I don't see a conundrum yet. He said, I came up with a value of 240 million. The stock is trading at 280 million. I still don't see a conundrum. I managed to throw conundrum in like 6 times in the 5 minutes I was talking to him. It's 240 million, the stock's trading at 280 million. Just don't buy the stock. He says, here's my conundrum. There's one very big asset that Playboy owns that I haven't counted in the 240 million. You know what he was talking about? The mansion. The company owned the mansion. And it's worth, at that point, one of the most valuable real estate properties in LA, about 150 million. See what his question was, can I add the 150 million to my 240 million? What's the answer to that question? First, is it counted already? Maybe if you have playmates, jumping around the mansion, you took, you made, but generally not, right? Playboy's revenues came from the clubs and the magazine wasn't counted. So I passed that test. But the second test is it a truly vacant asset? Can you sell the house or the Playboy mansion today? And there's one catch in that plan, which is there's an 80-year-old in a bathrobe hanging out in the mansion that you can't just evict without major PR problems. I'm talking about Hugh Hefner was still in the house. So he said, what should I do? I said, check the actuarial tables. So what am I checking for? 80-year-olds in bathrobes hanging out with 26-year-old playmates. Say, how long will they live? 5 years? Okay. We're done, right? Basically, take the value of the property, discount it back 5 years. You can use a real estate cost of capital, it makes you happy. And then I forgot all about it. And a few years later, I opened up the Wall Street Journal. And this was the most amazing story ever. Playboy managed to actually have their cake and eat it too. They sold the mansion with Hugh Hefner in it. I'm not kidding. This Greek millionaire, Darren Metropolis, bought the mansion. The conditions were that Hugh Hefner would continue to live in the mansion till he died, and then Darren would move in. That asset becomes, Playboy got $200 million. Overnight, he got $200 million in cash. This would have been a good time ahead of this action to invest in the company. This is a truly vacant asset, an asset that hasn't been counted. So the rule with other assets is make sure you're not double counting. If you're double counting, you're going to overvalue the company. But if it's already been counted, just let it go. Now, let me go back to the Waldorf example. I told you that I valued Waldorf as a hotel company at $1 billion, but as real estate, it's worth $1.5 billion. As an investor, when I look at the company, let's say it's trading at 1.2 billion, less than the value of the real estate, but more than the value of the cash flows you got as a hotel company. Would you buy, sell, or do nothing? Yes, go ahead.
Depends on default. If I'm expecting them to default and have to liquidate.
Is that good for you though?
Well, if they have to liquidate, then I'm investing.
Is there a way could you buy the entire, if you're buying the entire hotel, which of the two numbers would you use as your base value? You check the zoning laws first, and if you said, look, I can sell it, then you're willing to pay up to $1.5 billion. Obviously, you'd like to buy it at 1.2 billion. Then right after you do it, what would you do? You'd either sell the hotel to whoever pays you $1.5 billion, or you do what they did to the Plaza Hotel, convert it into apartments and condos and say it's worth a lot more in alternate use. So if you were an acquirer who controls the hotel afterwards, you would be willing. But if you're a passive investor, do you see the challenge is worth either $1 billion or $1.5 billion? There is a probability you can attach to each outcome. And that might be really low that they will be converted. And that might depend on who owns the business, what are their plans for it. But that expected value is going to be a number between the two numbers. So we're going to come back and address this as in the context of value of control, because this is part of the value of control, right? That you think an existing asset. But there is a game that people played about the peak of the housing boom about 20 years ago, where they tried to have their cake and eat it too in a different way. So you have JP Morgan, you go 277 Park, the value of the real estate has risen, you still have your bankers and traders there, so you can't count it. Is there a way you can take advantage of the high real estate pricing for this building and still be able to keep your bankers and traders in that building? The sale and leasebacks actually became a way in which people tried to capitalize on the difference between what the real estate market was pricing the building at and what was worth to you. So it is not always feasible, but you see sales and leasebacks increase when housing prices boom, especially in office housing, because you're trying to have your cake and eat it too. Which brings me to my third or fourth loose end here. Let's talk about complexity. Let me give you two companies, right? The two companies look exactly the same in terms of numbers, same operating income, same tax rate, same return on capital, same cost. So on a numerical basis, when you sit down and look at the numbers, they look exactly the same. But here's where they're different. The first company is in a single business. The second company is in multiple businesses. The first company has a very simple holding structure. What they own is on their balance sheet. The second company is special purpose entities and all kinds of other opaque holdings. The first company has transparent accounting, which means that financials tell you exactly what you need to know about the company. The second company has accounting statement that you read and don't even know what language it's in. It's so complicated. So basically, I have a simple company and a complex company. They have the same numbers. I want you to think like an investor. Think with your gut. Don't think in terms of models. Think with your gut. Which of these two companies would you value more highly? The simple company or the complex company? The numbers look exactly the same. And I would say simple too. But here's the problem I would face. If you open up my textbook and you start putting numbers in, after-tax operating income, return on capital, cost of capital, the numbers look exactly the same. I come up with the same value for the two companies. There's nothing in traditional valuation that would lead you to discount the value of the complex company. And here's the underlying assumption, the extraordinarily dangerous that we make, that we never state. We assume that what you don't know will get averaged out. That's basically what we assume. You buy 100 companies, you don't know much, things will. What's the danger in that assumption? Things that you don't know will get averaged out. What does it assume about the things you don't know?
Positive and negative.
Symmetric, right? The things you don't know in these complex companies are things that managers have chosen not to tell you. David, what do managers hold back? Good news or bad news? In fact, when was the last accounting scandal you woke up to where the company said, hey guys, we made 5 times more money than we told you we did? Notice the surprises always come in one direction. I'll tell you when this became an issue in this class. This section was not in my class in 2000. When Tyco had an accounting scandal. Tyco was a company that grew through acquisitions, a conglomerate, and the whole thing came apart because it turned out that they'd been holding back stuff. Things like how much money they spent on CapEx. They just forgot to mention it. The company falls apart, the stock price drops 80%. When Tyco's stock price collapses, GE's stock price drops by 15% as well. What's GE got to do with Tyco? What did I describe Tyco as? A conglomerate that grew through acquisitions. What did they do? What did they do? They used the acquisition process to hide a lot of dirt. As an investor, you see what investors were doing. That GE is a conglomerate, it goes through acquisitions. How do I know that GE is not pulling the same trick on me? They were discounting GE because they said there are things we don't know and they could hurt me. So I threw a question out for my class. The first question I asked was, hey, this seems unrealistic that we're not bringing complexity. And should we bring complexity into value? They all agreed, unanimous. We should bring complexity into value. I said, okay. To bring complexity into value, I need to answer 2 questions. One is, how complex is the company? I need a measure of complexity. And second, I need to take that measure and convert it into a way of bringing it to the cash flows, because the IT proposition kicks in. So for the first thing I said, how do you think we should measure complexity? They all had blank looks and they said, you're teaching the class, you came up with the topic, you come up with the measure. And I came up with the measure and they did not like it. You know what I did? Those days you actually had physical 10Ks and 10Qs. I counted the number of pages in a 10K. I know this is incredibly simplistic, these are just 10 companies, but if there's one company on that list you want to avoid valuing, which is that company? 1,026 pages. This is in War and Peace. This is how many pages it took them to tell me what happened in 1 year. You're one heck of a screwed up company if it takes you 1,000 pages to tell me what happened. But this was an accidental, right? Why did Citigroup end up being what it was when I put this table together? What did Citigroup do in the 1990s? First, it bought Solomon, brought an investment bank in. Then basically essentially bought real estate. In fact, they boasted about the fact that they were going to be a one-stop shop for everything you needed. You bought your house, you invested your money. Terrifying thought. Incredibly complex companies. So I said, number of pages in 10K seems like a pretty good measure. And the reaction was, we're not paying at that time $120,000 for an MBA. Inflation has kicked in there as well. To count pages in a 10K. I said, you're right. What was I thinking? I'll come up with, they said, we need a more sophisticated measure of complexity. So I came back the next session with what I call my valuation shit list. The technical term for all the things that bug me when I value a company. It's a completely subjective list and how much they bug me. I'll give you examples. A company that claims to be geographically diversified, but doesn't tell you where. Or it tells you where, but you don't recognize it. It's like a Lord of the Rings universe. I don't recognize that part of the world. I remember the first time I valued BMW. They said 7% of their revenues came from Oceania. And I'm trying to think of my geography. There's Australia, there's Africa, there's North America, there's South America. Where the heck is Oceania? Is it the lost continent of Atlantis? Maybe you're selling a lot of cars there. So I called the investment relations officer at BO. So They said Australia, New Zealand, and Indonesia. I said, what do they have in common? They're by an ocean. I said, that's your definition of Oceania? If I define that as Oceania, 85% of the world is Oceania, then I have what, Latvia and a few landlocked countries left? But you can see the problem you create for me when you mix together Indonesia. You've run into this when you look at the geographical breakdown for your country. You go, what are these guys thinking? You're telling me Europe, does it matter that my revenues are in Italy or Germany? Of course it does. So I take all the things that bug me, how much they bug me. I'm capable of building a spreadsheet on pretty much everything. I remember when my daughter had to go to college, it's a terrible decision maker. I said, I'll build you a spreadsheet. Tell me what matters to you with scores. No. And then you could pick based on scores. And then she completely undercut me because I came up with this high score for one of the schools. And I said, what do you think of this? She said, I don't like that school. And I said, why? Because I never visited. And I went to the restroom, they had one-ply toilet paper. I said, this is your basis for not going to a school? They have one-ply toilet paper? I should have put that into the spreadsheet if you told me. So a high score in the spreadsheet means you're a complex company. So I showed this to the class and said, do you like this more? And they said, this is much better. This is why we get MBAs. I said, there's one small catch. To get the score for sitting, what do I need to do? Read 1,000 pages. And I said, I don't feel like doing it. But each of you is valuing a company. They had the same assignment you did, right? They could see the train coming at them down the tracks, nothing they could do to stop it. They said, yes. And I said, this semester, in addition to valuing a company, I'd like you to come up with a complexity score for your company. They bitched and they moaned, but what choice do they have? They should have taken the number of pages that I suggested up front. But that semester, I actually got a complexity score for every company in the class. And there's some very interesting findings. First, there was no correlation between company size and complexity. We think of large companies as complex. No, there's actually small companies are complex. Second, some of the complexity was externally imposed. Every time accounting rule writers add a rule, it makes your financials more complex. But a lot of it was internal. Companies choosing to be complex because they wanted to be opaque. So when you see complexity, that's a factor. David, you had a question?
Is this more of a measure of sort of how sneaky the CFO team is?
Part of it, complexity is because complexity, as I said, is sometimes external, but it's often internal. So when a company says, we can't help it, we're complex, you say, who made you complex in the first place, right? I'll give you an example. Companies that grow through acquisitions are consistently more complex than companies that grow with internal investments. So some of this might be choices you made. So it's part stickiness, part business model. A company that grows with a business model that creates more complexity is going to be more difficult to value. The question is, what do I do about these companies? After all, the tools you have are cash flows, discount rate. So ultimately, if you want to bring complexity in, it's got to be in one of those numbers. I'll give you some suggestions. One is you can try, of course, in good times, people ignore complexity entirely. They let it go through. In bad times, they think of complexity as so terrible that they won't buy complex companies. But let's say you decide to go down the middle. You can try to adjust the cash flows with complexity. By doing what? By haircutting the cash flows. That's a fancy word for, I'm just knock the cash flows off by 10% every year. Why 10%? Why not? It's arbitrary. That's a weakness of playing with cash flows. The second is to push up the discount rate for complex companies. In fact, I told you I spent a month on complexity during that sabbatical. So I actually wrote a paper, and I'll send you the link. Don't read it. It's incredibly boring again. But basically, I took companies. I looked at. I took the S&P 500 broken into two halves based on some subjective judgments, simple companies and complex companies. And I computed an implied cost of equity, just like I do the implied ERP for each group. Complex companies at a cost of capital about 1 to 1.5% higher, you can increase your discount rate. But I'll tell you my favorite device for dealing with complexity. Remember, your job is to forecast the future, right? You forecast revenue growth, margins, returns on capital. If I have a company that I understand its business model, where it's getting its growth, what its competitive advantages are, I feel much more comfortable forecasting that out in the future. But if you give me a company where I'm not sure how you're making money, you're making a lot of money, but I'm not sure how. Even though your return on capital might be sky high now and your margins are high, I can't in good conscience estimate that you can maintain it because I have no idea how you got them in the first place. The late 90s, one of the most widely picked companies to value in this class was Enron. It's a star, $70 billion company. And every person who picked Enron ran into a basic question. What exactly does this company do? You remember how Enron described itself? What is its business? I'm sorry, fraud ultimately, but even without the fraud, what is their core business? What did they do? They claim to be energy traders. In my mind, I said, what does that even mean? They don't produce energy, they buy energy from one person. So the first question is, why are you able to charge a higher price? We are an intermediary. And that's where the fraud might have come in. They were also taking advantage of state rules that were very different. So they'd buy, power from Texas, sell it to California. They'd sell it at times when the power demand was high. It's a story that people ask, how do they make money? I mean, what is the competitive advantage of being a platform where you trade energy? And yeah.
Where do you draw the line, like the beta, what you're calling complexity?
See, the problem is with complexity, it's company specific. Ultimately, it's not going to show up in the beta. It's something that, in theory at least, should be company specific. So it's very difficult to think of a way you increase beta. You can increase discount rates, but it's got to be on some generic comparison of complex versus simple companies.
Artificial intelligence, you would consider being captured in the beta or in the.
I mean, I don't think artificial intelligence by itself increases your discount rate, it reduces it. It's a cash flow effect, right? Some companies are going to have higher margins and higher cash flows. So I think of AI as primarily a cash flow effect, not a risk effect. There's a disruption risk in some business. You're a consulting firm, I can replace you with AI. There's a higher failure risk. So use the failure risk as a way of bringing in your development. That's really cash flow effects, right? Lots of money up front and hoping and praying you get enough revenue growth and margins to cover it. So one way to bring in intrinsic valuation is to kind of hold back on the kinds of assumptions you make on companies where you don't quite understand how they make money. And that should be part of your story, right? When you look at the story, you say, this is why, and you can't think of a good reason why they will keep making money. That's a red flag saying, be more cautious. As a final part of this paper on complexity, I actually took the price to book ratios for every publicly traded company and regressed them against beta, growth, and ROE, which are kind of standard variables. And we'll talk more about this in pricing. But then I threw in the number of pages in the 10K into that regression. And I got a coefficient of minus 0.003. What does that tell me? Negative. More pages. Every 100 pages in my 10K knocks down my price to book ratio about 0.3. So Citi, which right now trades at 0.6 times book value, comes to you for some advice on how to increase it to 1.2 times book value. What do they need to do? Just knock 200 pages off your 10K. Sounds facetious, but what are we telling Citi? You become such a complex company that people can't even deal with it. Get out of two of the businesses you got into. It's, I think, a measure of what the trade-off is when you start to build a company that gets more and more complex. Final piece for today, I want to talk about debt. There are two places in your valuation we're going to encounter debt. One is when you compute cost of capital, right? There, the debt becomes a component of your cost of capital. And there, my advice is be cautious about what you include in debt. I gave you the rules I use, interest-bearing debt and lease commitments, and I stopped there. I don't include accounts payable, supplier credit, underfunded pension obligations. Even though I might be worried about them, I don't include them in debt. You know why? If I decide to be conservative, which is what many people think of, including everything in debt, from a cost of capital perspective, think of what I do to my cost of capital. I load up debt, I reduce the equity weight, I make my cost of capital lower. So in your zeal to be conservative, you've actually moved in the opposite direction. So when you do debt for cost of capital, be conservative. Count only interest-bearing debt and leases. Stop there. But once you value the company, there are two issues you're going to run into. So second place you encounter debt is you come up with the value for the entire business. You have to subtract out debt to get to value backward, right? So here's the first challenge. Should you be subtracting out book value of debt or market value of debt? To make this choice start, let's suppose you valued a firm at $1 billion. It has $1 billion in face value of debt, but it's a distressed company. So the debt is trading at half of book value. So if I use book value of debt, my equity is worth nothing. If I use market value of debt, then the equity is worth $500 million. If you're acquiring this company, Which of those two numbers would you use? You'd use book value, and tell me why as an acquirer you'd use book value. Because the minute you acquire the company, remember the default risk disappears. They're going to use your credit to back it up. That discount is coming from the fact that you're distressed. But if you're an investor, assuming this company will make it back, there's a going concern assumption, you'll use market value. The assumption being the market value is based on a going. It's a very dangerous assumption. We make it repeatedly in intrinsic valuation. We don't even think about it. With distressed companies, when you use market value, you're effectively assuming your company will make it through the bad times. And if you're worried about it and you don't think your company will make it, the failure risk is high, that's when you're going to bring in the liquidation value of the asset and say, that's what I should be basing my analysis on, because this company will get into trouble. So you finish subtracting our debt, you come up with the value of the equity. It's your last chance to take care of whatever else you have. Yeah. If AI disruption might be destroying your business, this is your last chance. You have lawsuits hanging over your company. No, in one of the worst acquisitions of all time, Bayer, the German pharmaceutical company, bought Monsanto 10 years ago. Why one of the most, this is a tough contest to win, but this was, I think, hands down, the stupidest acquisition I've seen. The rationale they gave was something about consolidating the animal feed business. I don't even understand the animal feed business and why you'd want to consolidate it. But no matter what the rationale is, when they bought Monsanto, they bought a whole heap of trouble. In what form? Monsanto owns Roundup. And those of you familiar with Roundup, there are, I think, 54,000 cases working their way through not just the US court system, but around the world against Roundup. I think New York State just settled for what, 11 billion. So basically, these are not tens of thousands of millions. This could be billions of dollars. If you ask me to value Bayer today, I could use discounted cash flow valuation. I could subtract our debt. I get to a value of equity. There's no way I'm paying that as my stock price because there are all these things hanging over me. So what would you do to bring in that expected payout? What did you have to do? First, if you try to take 54,000 cases and take each one, you're going to kill yourself. But usually if you have 54,000 cases, you're one step away from this becoming a class action suit. You're assessing the likelihood that you will lose the suit and what you will have to pay out if you lose the suit, which is not a financial question, it's a legal question. I get students from the law school. Anybody from the law school in this class? There are sometimes people who wander, and I think by mistake, into this class from the law school. And I remember about 10 years ago, two law students, they're in the last year of law school. They come and take this class, and they come to me after class and say, we don't want to be lawyers. And I say, if you have that problem, talk to your dean. This is not the kind of existential problem I can deal with. They said, we'd like to be in investing. And we want to find a niche. We're going to start off at a disadvantage. People who've been in finance, what can we do? And I said, basically, here's what you should do. Your business should be to target companies that are being targeted by lawsuits, which in the US will be what, hundreds of companies, and make your specific niche that you're going to spend all your time assessing these lawsuits and the expectation that they'll be consolidated. It's a legal skill, and you're going to invest on that basis. I really think that there is a niche investing market there for people who are willing to it's an incredibly boring space to be, the legal setting, and trying to bring it in. But I think that's got to be factored in somewhere. You can't just leave it to chance. So when we start off next class, one of the things we're going to talk about, the last segment of the loose ends, we're going to talk about stock-based compensation. How do you factor it in? What's the right way? Because it is the most mangled aspect of valuation that I can think of.
Oh my God, this was on speed. I don't think this. Hello.